Have you ever found yourself, wondering about taxes when you're earning money across borders, especially with investments? It can feel, well, pretty daunting, can't it? Today, we're doing a deep dive into international tax, specifically how capital gains are handled, when you earn in one country but live in another. We'll be exploring this thing called the Double Taxation Avoidance Agreement, or DTAA, between India and the USA. It can really make a difference to your finances.
That's right. And our goal here really is to demystify it all. DTAA, foreign tax credits. We want to make these tricky concepts understandable for anyone dealing with capital gains between India and the US. We'll look at it from both sides, an Indian resident earning in the US and a US resident earning in India. Break it down into clear, actionable stuff for you.
Okay, let's unpack this then. This deep dive, it's all about giving you clear insights, things you can actually use based on what we've looked into, so you can feel properly informed about your cross-border investments. So let's start right at the beginning. What exactly is a DTAA? And why is it so, well, fundamental for cross-border income?
Okay, so a DTAA, at its heart, it's basically a treaty, a financial agreement between two countries. Its main job is to stop taxpayers getting taxed twice on the very same income. Imagine earning money in, say, the US, and then India, your home country, wants to tax that exact same money again. The DTAA is there to prevent that, to stop that double hit. And the India-USA DTAA specifically, that was signed back in 1990, a while ago now. Its whole purpose is relief from double taxation. For individuals, for companies, anyone who's a tax resident in one country but earning income in the other, it really helps international finance flow more smoothly, stops it becoming a headache.
Right, right. It's like a set of rules for fairness.
Yeah.
Makes sense. Okay, so we get what it's designed for, but how does it actually work? When we talk DTAA, some specific terms always seem to come up. Can you walk us through those? What do they mean?
Absolutely. There are a few key ideas you really need to grasp, especially for capital gains. First up, the source country. Simple enough, that's just where the income comes from, where it's earned. So if you sell shares on the Indian stock market, India is the source country for those capital gains. Makes sense.
Yeah, source is where it starts. Got it.
Then you have the resident country. This is where you live for tax purposes. So an Indian citizen maybe moved to New York, living there. The USA would likely be their resident country for tax.
Okay, source and resident. What else?
Then we get to how they stop the double tax. The main method, and this is key for the India-USA agreement, is the tax credit method. This means your resident country gives you a credit for taxes you've already paid in the source country. It's like your home country says, okay, you paid $100 tax over there, we'll knock $100 off your tax bill here.
Ah, so it reduces your tax bill at home.
Exactly. The other way is the exemption method, where the resident country just ignores the foreign income for tax, but that's less common, especially between India and the US. For them, it's pretty much all about the tax credit.
So it's not about making the income tax-free altogether.
No, not usually.
It's about making sure you don't pay the full tax in both places.
Yeah.
That's a really crucial difference, isn't it?
It absolutely is.
So this tax credit method, how does that actually work day to day? Let's take an Indian resident. Say they make some capital gains over in the U.S. How does India handle that?
Right. Good scenario. So for an Indian resident with U.S. capital gains, India uses that tax credit method. It's written into their law, Sections 90 and 91 of the Income Tax Act. Basically, if you make gains in the U.S., pay U.S. tax on them, you can then claim a credit for that U.S. tax payment against your Indian tax bill on that same income. Let's use an example, make it clearer. Imagine an Indian resident sells some U.S. stocks. They make, say, $10,000 in long-term capital gains, LTCG. Maybe they pay $1,500 tax on that in the U.S., let's say at a 15% rate. Now, that same $10,000 gain, it's also taxable back in India. Maybe the Indian rate is 20%, so that's around, what, 1,66,000 rupees tax due in India. But because of the DTAA, India gives a credit for the $1,500 U.S. tax paid. They convert it to rupees, of course. And that credit directly cuts down the Indian tax you owe. It stops you paying the full whack twice.
That sounds really useful.
Yeah.
But what about the practicalities, the paperwork? What does someone have to do to make sure they actually get that credit in India? Any pitfalls?
Yes, the paperwork. Crucial. You can know the rules, but mess up the forms and, well, for Indian residents, the big one is Form 67. You absolutely have to file this. And this is important. It must be filed before the due date for your main income tax return.
Before the deadline, not with it.
Before it. Miss that deadline, even by a day, and you lose the credit for that year. It's a strict rule.
Wow, okay. Good to know.
Then you need solid proof you paid the foreign tax. So things like your U.S. tax return, that's IRS Form 1040. Or Form 1099, which shows investment income like dividends or stock sale proceeds. Or just official receipts showing you paid the tax. And you'll also need a tax residency certificate, a TRC, that proves to the Indian tax authorities where you're resident for tax purposes.
So keep everything file Form 67 on time. Got it. Now let's flip it. What about a U.S. resident or a U.S. citizen earning capital gains in India? How does it work from the U.S. side?
Okay, the U.S. side. The U.S. taxes its citizens and residents on their income from anywhere in the world. Worldwide income.
Right, they tax everything.
Pretty much. So if you're a U.S. resident and you earn income in India, like capital gains, that income is subject to U.S. tax. But just like India does for its residents, the U.S. system allows a foreign tax credit. It's under their rules, IRC Section 901 and related bits. It's the same idea, a credit for taxes paid to another country. Let's do an example again. Say a U.S. resident earns 5 lakh rupees in long-term capital gains from selling Indian shares. They might pay Indian tax on that, maybe 62,500 rupees, perhaps at a 12.5% rate, which is common for those gains in India.
Okay, tax paid in India.
Now, back in the U.S., that same 5 lakh rupees gain is also taxed. Let's say the U.S. tax rate is 15%, so the U.S. tax would be 75,000 rupees. But thanks to the DTAA and U.S. law, they get a credit for the 62,500 rupees already paid in India. So the net U.S. tax they actually owe on that Indian gain is just the difference to 12,500 rupees.
That illustrates it perfectly.
Yeah.
So for our listeners based in the U.S., what are the critical forms? Is it just one main form, or are there others to watch out for, things people forget?
The absolute key form for U.S. residents is Form 1116. That's the foreign tax credit form. That's where you calculate it all and claim it.
Form 1116. Okay.
You'll obviously need your Indian tax documents to back it up. Things like Form 16A, which is a certificate showing tax deducted at source in India, if that happened. And your Indian TRC helps too. And yes, there are definitely things people forget. Big ones are the other reporting requirements for foreign assets. Depending on how much you have overseas, you might need to file Form 8938. That's the Statement of Specified Foreign Financial Assets. Basically lists your foreign accounts and assets over certain thresholds.
Asset reporting.
Yeah.
Separate from income tax credit.
Exactly. And then there's the FBAR report of foreign bank and financial accounts. That's filed separately with a different agency, FinCEN, not the IRS.
Right.
If you have foreign bank or brokerage accounts over a certain value, you need to file it.
So Form 1116 for the credit, but also possibly Form 8938 and FBAR for reporting the assets themselves.
Correct. Forgetting those can lead to some hefty penalties, completely separate from the tax calculations. So definitely need to be aware of those too.
It's good to understand the specific laws behind this. Yeah, the why behind the how. Can you give us a quick rundown of the main legal sections involved without getting too lost in the jargon?
Sure, happy to. On the Indian side, the main one when there is a treaty, like with the USA, is Section 90 of the Income Tax Act. That's what brings the DTAA provisions into force under Indian law. If there wasn't a treaty, India has Section 91, which offers unilateral relief. That's not our focus here. There's also Section 90A for agreements with specific associations, but again, less relevant for U.S.-India capital gains.
So Section 90 is the key for DTAA with the U.S. from India's side.
Pretty much. Now, for the U.S. provisions, the big one is Internal Revenue Code, or IRC, Section 901. That's the basic rule establishing the foreign tax credit, your right to claim it. But then you have IRC 904. This one's important. It sets limitations on the credit.
Limitations? How so?
Well, it basically says your foreign tax credit can't be more than the U.S. tax you would have paid on that same foreign income. It stops you using, say, high foreign taxes on one type of income to wipe out U.S. tax on your U.S.-based salary, for example. It keeps the credit focused only on preventing double tax on the foreign earnings.
So it caps the credit based on the U.S. tax rate on that income.
Exactly. It maintains fairness. And then, as we said, Form 1116 is the actual form individuals use to calculate and claim the credit under these rules.
Okay, knowing the rules is great, but avoiding the traps is maybe even more important. It sounds like there are quite a few ways to stumble. What practical tips do you have for listeners in India, listeners in the U.S.? What are the biggest mistakes you see people making?
Absolutely. The practical side is key. Let's break it down. For non-resident Indians, NRIs, living in the USA, remember, your capital gains from Indian shares, they're generally taxed in India first, often at 12.5% for long-term listed shares. You must report this income on your U.S. tax return. No hiding it. Then, claim the foreign tax credit using that Form 1116. and attach proof your Indian PRC evidences you paid the Indian tax.
Okay, report and claim with proof for NRIs in the U.S.
Right. Now, for Indian residents earning gains in the U.S., report those gains on your Indian income tax return, your ITR. Then, claim the foreign tax credit using Form 67, and critically, keep all your IRS documents, Form 1040, 1099s, payment receipts. The Indian tax authorities will want to see proof you paid U.S. tax.
Keep everything for Indian residents claiming U.S. tax credit. Makes sense. Now, the mistakes.
Okay, common pitfalls. Biggest one, simply not filing Form 67 or Form 1116. You might think the DTAA automatically applies. It doesn't. You have to claim the credit via the form. Fail to file, you get no credit. End of story. You pay tax twice.
Ouch. So filing the form is non-negotiable.
Absolutely. Second, not keeping proper proof of the foreign tax paid. If you claim a credit but can't show a receipt or tax statement, the tax authorities, whether in India or the U.S., can just deny it. Third big mistake, assuming income is exempt. This is a major misunderstanding. Most capital gains under the India-USA DTAA are taxable in both countries. The treaty provides a credit, not usually an exemption. Thinking you don't need to report it or pay tax anywhere is wrong and leads to trouble.
So the DTAA helps you avoid paying double, but not avoid paying tax altogether usually.
Precisely. And finally, a technical but common error, using the wrong exchange rate. You can't just pick a rate you like. You generally have to use the official rates published by the Reserve Bank of India or the IRS for the specific date of the transaction or tax payment. Getting this wrong can mess up your credit calculation.
Wow. It really is about the details, isn't it? A small slip on a form or a date can have big consequences.
It certainly can. Meticulous record keeping and understanding the process are vital.
Are there any specific types of capital gains that cause particular confusion or need special attention under this DTAA?
Yes, a couple are worth highlighting specifically. First, capital gains on listed shares. Like we touched on, India generally gets the first right to tax gains on sales of shares in Indian companies, so tax is paid there. But the U.S. taxes its residents on worldwide gains, so you report it in the U.S. too. The key is diligently claiming the FTC, the foreign tax credit, in the U.S. using Form 1116 for the tax paid in India.
So Indian shares tax in India first, then report in U.S. and claim credit.
Exactly. The second common one is real estate in India, selling property. If a U.S. resident sells property in India, India will tax that capital gain, often at 20% for long-term gains, though they allow indexation to adjust for inflation, which helps. The U.S. will also tax that gain, typically at 15% or 20%, depending on the U.S. resident's overall income.
Same situation as shares then, really.
Pretty much the same principle. Taxed in India first because the property is there, then taxed in the U.S. because the owner is a U.S. resident. The solution: claim the foreign tax credit on Form 1116 in the U.S. for the Indian taxes paid.
Okay, that clarifies those specific cases. This has been incredibly thorough. So for our listener trying to absorb all this, if they could just remember a few key takeaways, what would be the absolute essentials? Could you maybe summarize it quickly?
Sure, let's boil it down to the essentials. Capital gains taxation. If you're an Indian resident earning in the USA, it's taxed in India, but you get a foreign tax credit, FTC, for U.S. tax paid. If you're a U.S. resident earning in India, it's taxed in the USA, but you get an FTC for Indian tax paid. Key form in India, that's Form 67. Need to file it before your tax return due date. Key form in the USA, that's Form 1116. Filed with your U.S. tax return. Main law section in India, generally Section 90 of the Income Tax Act. Main law section in the USA, generally IRC Section 901 and 904 for limits. Is there a treaty? Yes, the India-USA DTAA applies to both situations. Is credit allowed? Yes, the core mechanism for relief is the tax credit in both directions.
That's a great quick reference. So wrapping this up, what does this all really mean for you, the listener? Well, it means getting your head around these agreements isn't just about ticking boxes for the tax man. It's actually about protecting your own money, making sure your hard-earned gains from investments aren't unfairly eaten up by being taxed twice.
Right.
It really shines a light on how vital good record keeping is and why it's sometimes necessary to, get clarity, maybe even professional advice when you're dealing with money across borders.
Yeah.
It's a key part of managing your finances internationally.
And just to reiterate that core point about the DTAA itself, remember, the double taxation avoidance agreement between India and the USA, the one from 1990, it exists specifically to give you relief from double taxation. Mostly it does this through the foreign tax credit method. That mechanism lets you use the tax paid in one country to directly reduce the tax you owe in the other on that same income. It's designed to prevent that unfair double burden on your capital gains.
Well said. All the best to you out there navigating your own financial journey.
And we will meet again with another important tax matter in our next meeting.